Good evening. Welcome to our Association of Former Students, Texas A&M University Homebuyer Workshop. My name is Jason Maida. I'm going to be your presenter this evening. It's great for you to join us. We're so grateful for the opportunity to be able to help teach a little bit more about home buying for you. And we're grateful, obviously, that you took time out of your busy schedules on a Wednesday night to join us. I know everybody's kind of getting into the session right now, so we're going to allow everybody to do that. While we wait for everyone to join, because we had a lot of signups for tonight's class, I want to kind of explain you a little bit more about our class and maybe some logistics for tonight's discussion. This is a very interactive session, so as we go through tonight's content, we really encourage you to ask questions of this. This is kind of more of a conversation on home buying as we talk through some different ideas around that. And this runtime for tonight's class will take us up to about the hour. We're going to weave in those questions that you ask us. You can ask those questions by using either the chat function or the Q&A function within Zoom, and then myself and my partner Ken will answer those questions live on air for you. We're also recording tonight's class, so we'll have this class up on our YouTube channel tomorrow. We'll send you the link as well as the presentation material, and by signing up for tonight's class, we have your email on file, so we'll get this out to you. All right. We're excited to bring this content to you. This is the first of 4 installments of classes we do for our partnership with Texas A&M. And, we hope you enjoy this. And, this has been a really great partnership in helping educate future first-time home buyers. We've had several clients that attended class just like this that you're joining tonight actually utilize us for their financing to help them achieve the dream of home ownership. So really cool opportunity to be able to help those folks. Well, again, my name is Jason Maida, and I'll be your presenter this evening. And just a little bit about me. I work for an organization called American Pacific Mortgage. We're a top 10 lender in the country. We are a nationwide lender. So whether you're in the Dallas area, you're in Houston, you're in Colorado, California, or on the East Coast, we can help serve you whatever your desire is in terms of location for your home purchase. We start off in our relationship with future clients in classes just like this. So we usually connect with our clients through our educational platform in one of our 16 partnerships all across the country. And then ultimately we meet with you to design home buying options for you. Now, whether you're leaving tonight's class thinking, hey, I want to buy this year in 2025, or maybe this is a goal that you have for the next 2, 3, maybe 4 years down the road, we just want to provide you with the education and resources to help you make what was going to probably be one of the biggest financial decisions you decide to make. So we want to make sure we give you all the information you need to feel like you're an informed consumer. Well, here's our talking points for this evening. We're going to look a little bit at the housing market in just a bit. I also want to spend some time diving into interest rates. And from there, we're actually going to launch our class by looking at a rent versus buying calculator. So we're going to compare what does it look like if I decide to go down the path of continuing to rent for the next several years, or if I decide to switch up my lanes and maybe go into more of a buying situation. So we want to kind of compare some notes there on what those differences look like. From there, we want to also talk a little bit about credit and how do I have myself prepared from a credit perspective, whether that's paying down debt or credit card debt, or just understanding a little bit more how to optimize my credit score. From there, we're going to talk a little bit about loan programs. So there's a variety of different programs you can elect as a buyer. We're going to kind of spotlight 5 programs that can help you on that path towards homeownership. And then we want to talk a little bit about savings tonight. So that's one of the challenges for some first-time buyers is, maybe I just don't have enough money saved, but I really want to buy a house. How do I start creating a savings plan for myself today, right? We'll also talk a little bit about first-time buyer programs, specific in the state of Texas and other states across the country. There are first-time homebuyer programs. I'm going to dive into some state-specific ones for Texas tonight called this Texas State Affordable Housing Program. So we'll look at that tonight. And then we'll also talk a little bit about the buying process. So after tonight's class, I may want to start my path towards homeownership and connect with us for a consultation, where we're going to show you what the milestones look like in pursuing homeownership and how you too can take those next steps in homeownership. All right, so that's our plan for tonight. Again, I'm glad you're joining us for tonight's discussion. We're really happy to be a part of this with you. So let's go ahead and dive in. I know we got a lot more joining tonight's class, and I can see our room starting to fill up here. But let's go ahead and dive into our first topic, which is essentially, does buying make sense for me? Now, this is going to be one of the biggest financial decisions you decide to make. So obviously, you're taking time out of your busy Wednesday night schedules to join us for an hour. So clearly, you understand the importance of buying and what that means to your financial picture. But I think it's important to consider also, what are the benefits that come along with buying? Well, number one is I can create stability by owning a home and having a little bit, hopefully better affordability, because now I kind of control the budget that I pay for on my housing expense, right? I don't have to worry about the landlord that's going to increase the rent every year that I decide to renew my lease. I can kind of control my own destiny from that perspective. Now, for those of us that choose to purchase in today's market, the reality is we are at slightly elevated levels in interest rates, but for many of our buyers that decide to purchase today, the reality is in a year, 2 years down the road, when this interest rate market starts to settle a little bit, there'll be opportunities to refinance their homes and, of course, drop the payment, which ultimately improves that affordability for an existing homeowner. Now, purchasing a home is an asset, and that asset should build wealth over time. So as that home grows up in value, as you pay down the balance of your loan, we create home equity. And for most of us across the country, that's the number one asset that we have. And that has the opportunity in some cases to create generational wealth for our families. The third thing I would want to point out is there's some tax benefits that come along with owning a home. So believe it or not, there's mortgage interest to tax deductibility for some buyers, which can be a huge opportunity for us. There's also potential tax benefits that come along with the energy efficient upgrades that I make to my home. So when I think about owning a home versus continuing to rent, I really have to factor in some of those benefits into the equation, because what I would say is not really like an apples to apples comparison when I think about renting versus buying. To help us kind of along that path of doing that comparison, I thought I would drop us into a rent versus buying calculator, which is essentially going to show you a side-by-side comparison of renting versus deciding to own a home. Now, before I dive into this calculator, I just want to let some of our new attendees that just popped into the room. We are doing open Q&A as we go through tonight's content. So if you do have questions, just drop them in the chat or Q&A. Myself and my partner, Ken, will answer those questions on air. We'll, of course, carve out some time later on at the end of class, but our run time for tonight's class will take us up just to about the top of the hour. All right. Well, let's take a look at this rent versus buying comparison. Now, we've kind of pre-filled in some of these fields just to keep us on track for our timing tonight, but I want to kind of walk you through this calculator. And I would encourage you, when you have some time later on this week, maybe try to do your own calculation. I think it would be super helpful for you as you're planning towards home ownership. So the first section we're going to look at is renting. So we have an assumption that I'm paying, let's say, $2,000 in rent. We have monthly renter's insurance estimated at $15. So we have that kind of in our rental section. And then we're going to assume that our rent price is going to increase about 3% on an annualized basis. All right. So that's in the rental side of things. And then we're going to drop into this home purchase tab. So we look at a purchase price of a home around $400,000. We make the assumption that my down payment at minimum will be 3%. Now that's 3% for a first-time buyer when we use a conventional home loan product. And we'll talk about that in our product section in tonight's class. Then we have property taxes, which will vary based upon where we're going to purchase in the country. Now, if we're going to look in some of our Texas markets that we support, obviously, as many of us know, that those property taxes might be a little bit higher as compared to other parts of the country. And of course, that'll change, and we'll kind of build that into our scenario. We have homeowners insurance rates that change based upon location. We have maintenance costs for our home, so we factor that into our numbers. And then we have loan information. So for most of us that are first-time buyers, we're going to elect a 30-year fixed mortgage product. We take an estimated interest rate, which we'll spend some time talking about those tonight. We have origination costs that ultimately are the cost that you're paying to a lender to provide you financing options. Now, one of your additional benefits you get for our former students is we get a chance to discount our cost for you by $750 as being a client of APM. So that's one of our added benefits, in addition to, of course, the classes that you have available to you, like tonight's session. And then we have discount points noted here too. Now, what discount points are, that gives you the ability as a buyer to essentially bring down your interest rate, but it does require you to put costs out of pocket. Now, generally, one discount point is the equivalent of 1% of my loan amount. and that will generally bring down my interest rate about 0.25%. So that's what a discount point looks like. Now, for many of us that are deciding to buy right now, that discount point that we invest into bringing down my interest rate usually takes about 3 to 4 years to recoup. So I'm not a huge fan of paying those out-of-pocket expenses, because many of our clients, as I mentioned in our buying benefits section, is that they're probably going to refinance in a couple years from now, which refinancing means that I'm taking my existing loan balance and now refinancing that balance at lower market rates. So if I'm going to do that in a couple years, it probably doesn't make a lot of sense to invest in discount points. Now, then we have other settlement services like title, escrow fees, maybe attorney fees, depending on what state you're going to buy in. And then we have other assumptions like, what's the appreciation rate look like in my home? How long do I think I'll be there? How much is it going to cost me to sell my home when I get to the end of 7 years? Because maybe that's the timeline that I plan on staying in this property. And then we have state and federal tax rates, and then the savings rate. So what our calculator ultimately kind of shows us is a few important things. One is, what is my budget going to look when I side by side the comparison? Well, if I'm paying $2,000 in rent, it's going to look a little bit different if I decide to buy a $400,000 home. In fact, my budget goes from $2,000 a month to $3,700 a month. So one is, I have to be prepared from that perspective. But when we look at the total cost opportunity, when I look at renting for the next 7 years versus deciding to own for the next 7 years, my opportunity comes in my equity appreciation and my potential tax deductibility benefits of owning a home. And in fact, it's about $39,000 that I save in owning a home versus deciding to continue to rent. Now, that looks a little bit different for everyone. Obviously, if I'm going to purchase a much higher price point and I'm paying $2,000 in rent, that calculation looks a little bit different. Or if I'm paying $1,000 in rent, that's going to look different as compared to buying a $400,000 home. But I would encourage our class to, if you have some time this week, dive into that calculator yourself. I think it's going to be a good experience for you to kind of understand what this looks like for you. And I think hopefully one of your takeaways is comparing renting versus to a mortgage or a home buying is really not going to look the same because of all those added benefits that we get along with ownership. All right. Now let's try to transition. I want to talk a little bit about the housing market. We are currently in the spring/summer buying months. For most parts of the country, that's the busiest time of the year. That's when, weather starts getting a little bit nicer. People are out and about, and usually more listings or available homes come on the market, which is something we desperately need across the country. We do have some challenges from an inventory perspective that has been, difficult for some buyers. But there is good news ahead. We are seeing some inventory increases year over year. In fact, our Texas market is one of the top inventory markets in the country. That includes also Florida, Georgia, and Colorado. So there's more inventory to support buyer demand. So we're going to have to see how that plays out, because ultimately, as buyer demand increases, the supply, if we have plenty of supply, then prices will stay pretty level, right? But if we have more supply than demand, then prices could decrease a little bit. And you're seeing prices, drop from a year over year. You can see we were at 350 back in 24. We're kind of maybe more in the 337-ish range in median price. So we'll kind of have to see how that plays out. But that is good news for you as first-time buyers. If you decide to enter this market, you're looking at a price point that's lower than buyers experienced back last year in 2024. Here's the other good news from that perspective too. 44% of all transactions across the country have involved some type of what we call seller concession, which essentially means is that sellers have contributed towards helping buyers with closing costs or reductions in ultimate price of homes. So 44% of all transactions across the country. Now, it depends on which market we're talking about. We'll have more than others, but that is good news from a buying perspective. I'm not here to say that we're necessarily in a buyer's market yet, but it has some similarities or some indicators that we could be transitioning from a seller's market to a buyer's market in some parts of the country. So good news on that front. Spring and summer buying is our busiest time of year. So that's when we see a lot more people getting their pre-approvals updated or engaging with us and getting their applications completed to build a home buying plan. And certainly, if there's inventory out there or supply to support our buyers, that's really good news from that perspective. Okay, so I got some questions popping in. I'm going to kind of try to answer these as we kind of go through different topics. One question that popped in, which was, what are the conditions that allow mortgage payments to be tax deductible for some homeowners? Is it more common than not? So it's not necessarily the payment that can be potentially deductible. It's the interest on an annual basis that can be potentially tax deductible. Now, everybody's tax bracket and deductibility opportunities look a little bit different. I would encourage you to talk to a tax professional to see what your tax deductibility benefits look like from a mortgage interest perspective. Okay. And then, okay. And then, okay. I think we got that question. So Ken took care of the other one for me. So, all right. Appreciate the question there. Let's talk a little bit about interest rates. A lot going on in economic news. If you're paying attention to what's going on in news in general, or even just looking at your 401k statements, it is going to be a change week by week as to what's going on. Obviously, we've had some massive drops in the Dow Jones Industrial Average. Then we see some massive upticks in the Dow Jones. All kind of this uncertainty, if you will, around tariffs and kind of what's happening, what the short-term and long-term impacts could be to our economy. So we're watching things obviously pretty carefully in the interest rate space right now. Now, if we look kind of just at interest rates in general right now, we're about in the high 6s to 7% range, depending on what day we're looking at. Interest rates change by the minute. So as trading begins on Wall Street, that's when interest rates can start to fluctuate. And so they can look differently at 8 o'clock in the morning versus 2 o'clock in the afternoon. So it really just depends. But this 12-month look of interest rates show you what we've dealt with in the last 12 months. So a little bit of a roller coaster ride here. We just 3 weeks ago, as of Friday, had our lowest levels of 2025 based upon kind of the implementation of these tariffs and what was happening. And that was quickly derailed by some other kind of changes with tariffs. And so this kind of on again, off again situation is kind of really influencing interest rates up and down. We're really looking for some stable landing in interest rates. Prior to the talks around tariffs, really the two drivers for the Federal Reserve was what's inflation look like. So we have a 2% inflation goal, and we're looking for a strong labor markets in order for the federal funds to start bringing down the Fed funds rate. The reason why we're at these elevated rate levels is to combat inflation. And we feel it, obviously, as consumers, right? We go either whether it's the grocery store or going to put gas in our cars, those things are more expensive these days. And so, we had a reading come in on the core PCE of inflation. That looks at manufacturing cost, essentially. That came in a little bit higher than expectations. So not the number we're looking for in terms of interest rates, because we want to see inflation go lower, because ultimately that'll potentially lead to the Federal Reserve reacting with a cut of interest rates. Now we're expecting the Federal Reserve to possibly cut interest rates twice this year. And then that will directly impact what we see from credit card expenses, personal loans, car loans, and then it will ultimately kind of ripple effect into mortgage interest rates. Last thing I want to touch on in interest rates is just what we've seen in the last 20 years in interest rates, because I think it's important to understand that interest rates do cycle. We're unfortunately in kind of a higher cycle. We will start to see things kind of drop down. But when we look at 20 years from now, or going back 20 years from today's date, interest rates were about the same. Now, obviously, different components within the housing market. Homes were a lot cheaper then, but right around the same level of interest rates. And then you can see kind of as we move across this 20 years, you can see this bar here represents the housing crisis of 2008, 2009. This gray bar here represents the pandemic. And I think the thing I would want to just share with our audience here is that the reality is interest rates aren't going to return to pandemic levels of 2.5% and 3% level. That was obviously catastrophic events going on globally. If we get back to those levels, then obviously we have some serious things going on in our world. So hopefully we don't get back to those levels. But I think historically speaking, interest rates generally land in a 5%-ish range. So we're certainly above those historical averages. And, the better we can get interest rates to perform, so lower interest rates, obviously that sparks buyer demand. And we're already seeing some of that even in today's market. Now, I think it's important to understand what goes into an interest rate. So it's not just a one size fits all when it comes to interest rates. Various factors like credit scores and product eligibility go into interest rate. what type of program I'm going to use, how much I decide to finance, what does my down payment percentage look like? So if I'm putting 3% down versus putting 20% down, my interest rates are going to look a little bit different. We talked a little bit about buying down your rate with points and kind of the rationale that we apply to that. You can certainly do that to bring down your interest rate. And then the term of your loan can generally influence your interest rate. So if I decide to go from a 30-year mortgage to maybe a 20-year mortgage, that could help lower my interest rate. Now, as we connect with clients in our local communities to serve them in homeownership, we're going to figure out which product makes the most sense for you. So when you decide to take those next steps in homeownership, we're going to meet with you on video just to figure out what's the right design and product match for you, and then talk a little bit about their interest rate environment based upon what your product looks like that you're applying for, and of course, what your timeline looks like for home buying. Because if I'm looking to buy in 2025, that might look a little bit different than, say, I'm buying in 2027, right? All right. Let's talk a little bit about credit. And credit is one of those kind of opportunities, if you will, as we build home buying plans for clients that we can dive a little bit deeper in, educate our buyers, and figure out how to really optimize credit score, especially if we're trying to get that lower interest rate option or maybe get into a particular product. When I look at home ownership for our buyers across the country, there's usually two areas of opportunity, or I shouldn't say areas of opportunity, maybe challenges to a certain extent. Could be around credit, because maybe I'm a little bit overextended with maybe student loan debt or credit card debt. But on the other side of it, it's going to be on the savings side of it. And we're going to talk more about that in tonight's discussion. Now, every product that is offered has minimum credit score requirements, and we gave you kind of a snapshot of what those look like right here. And we're going to dive a little bit deeper into those products into tonight's discussion. We're going to talk a little bit about different score factors that go in. Now, when we look at credit scoring, usually in the most recent 12 to 24 months, that's going to have the bigger impact to your score. So if I've had maybe a late payment back in October of 2023, I'm still kind of in a 24-month window of when I achieve that late payment. That's probably going to have a bigger impact on my score versus maybe a late payment that I had back in 5 years ago or something. All right. We are going to spend some time talking a little bit about credit utilization, and we're looking at credit utilization as comparing credit limits on our credit cards versus, say, the outgoing balances that I currently have. And then we'll talk a little bit about account closure when we look at our kind of a weighting of the credit score. Now, I think it's important to understand, and I know many of us in tonight's class have some type of monitoring system when it comes to their credit. So you might use Credit Karma or some of the credit agency tools that are offered through TransUnion, Experian, or Equifax. That's all great. There are 3 different scoring models to credit scores. There's the credit card model, there's the auto financing model, and then the mortgage model. Now, of course, when you apply for home financing, we're using the mortgage model. There are 3 different scores that appear. So each agency has a score. So for example, if I'm at 760 as my top score and my middle score 740, let's say my lowest score is 720, then as a borrower, the score that I use in lending to qualify the client is a 740 credit score. So that's what we call the middle credit score. Now, if I'm going to apply with my partner, and let's say my partner is at 700, 680, and 660, well, the lowest middle score between the two of us is a 680 credit score. So the 680 score will be what is used for qualifying. So that's important as a takeaway, because ultimately that lower middle score could change what looks like from a rate perspective, maybe the product that we're going to elect, cost of mortgage insurance, which we'll dive into tonight as well too. So we want to be very strategic in how we build these home buying plans for clients to ultimately to create the lowest borrowing opportunities for them. Now, this is a matrix that shows you how long things will stay on your credit. So usually it's a 12 to 24 month impact to the score. But in terms of the legacy on the credit report, this is how long items will stay with you on your credit file. All right, let's dive into the mortgage score calculation. So again, many of you are probably subscribing to some type of monitoring service, but I think it's important to understand how the mortgage score is built, so we can ultimately kind of maximize opportunities for you in your credit score. So let's take a look at this. So the first component is length of credit. Ultimately, how long have I had credit? So the longer my credit file has been opened, probably the higher my credit score is. So, if I look at someone that has a 6-month credit history versus a 6-year history, ultimately the 6-year history, assuming everything is paid on time, probably has a higher credit score. It usually takes at least 6 months of an active account to actually be on the grid in terms of have an active reporting credit score. Now, the next one is 20% of the weighting. That's any type of new account that I'm opening or inquiry that I'm having on my credit. So we want to have a balance of not opening too many accounts at one time, but also having enough to show at least stable credit as my profile. Now, we want to be aware that we don't want to open up too many accounts, especially in a recent 6 to 12 month period. And we want to avoid having hard inquiries done on our credit file. That's when a lender, whether that's a mortgage company, credit card company, auto financing, they're doing a hard credit inquiry on your file. So we want to really avoid that. Now, there are rules in place that state that if I'm going to go apply for home financing, I can have an inquiry done as long as it's done by all the lenders within a 30-day window of time. That has one impact as an inquiry to my credit score. Now, one of our benefits and how we try to make sure we can best support our buyers is we only start with a soft credit check with our team. And the reason why we do that a little bit differently, especially for our clients coming out of classes like this, is, our buying timeline looks a little bit different, right? It might be 3 to 6 months. It might be 3 years down the road for buying. So we want clients to understand their options, but not necessarily have their credit score impacted. So we always start with that soft credit check. Next side of it is the amount owed. So this is around credit utilization that we kind of talked about a few minutes ago. Ultimately looking at credit card balances versus credit card limits. So if I have outstanding balances of, let's say, $5,000, my credit limit's $10,000. Right now I'm at 50% credit utilization. So that's where I currently stand. Now, if my credit balances are slightly higher than that, maybe they're $8,000, that means I'm at 80% utilization. So if we're trying to really move towards a higher credit score and I have those $8,000 in balances, my first action item would be, let's try to pay those balances down to $5,000, and that would see a lift in our credit score. The next level would be a $3,000 balance. That means I'm at 30% utilization. Now my score edges up a little bit higher. And then the optimal level is below 10% or less utilization. So meaning those balances are at $1,000 or less. All right. We had a question that came in the chat, which is what length of credit is recommended before applying for a loan? So there's not necessarily a recommended length of credit, but in terms of have a reportable credit score, usually you need to have an account open for at least 6 months. Okay. All right, now let me just give you a quick tip on how to manage down utilization. So every month on the billing cycle close date or statement date, the credit card issuer is going to send out your information to the credit agencies. They're going to report how you paid your bill, what your credit limit is, what your balances are, so on and so forth. What my tip for our class tonight is that if you can do your best to try to pay down the balance or pay off the balance before the end of the billing cycle date, the statement date, then you're going to get a lower credit balance that reports out to the agencies, a lower utilization, and ultimately help lift your credit score. So that's how I would try to manage credit card debt. Don't pay on the due date. Try to pay before the end of the billing statement date. Okay, so a little bit of a change up in approach. Last component is payment history. That's ultimately how am I paying my bills. So if I have a late payment, it's going to be rated as a 30-day late, a 60-day late, or even a 90-day plus day delinquency. The more significant or severe, if you will, the late payment is, the bigger impact I'm going to have on my credit score. Now, again, we're looking at the score being impacted from an event that has happened in the most recent 12 to 24 months. So the further I get away from that negative item, I'll probably see some kind of organic improvement in my credit score. All right. All right, now we're going to talk a little bit about student loans as our next topic. Any other questions on credit before we spend some time looking at student loans? All right, I know we've had some good questions already coming in, so keep them rolling. So a question did come in, which is, does the credit bureau automatically roll into one hard inquiry if they are in the 30-day period, or do you have to request this? So it should automatically roll into the formulas are already set up within the bureau. So if I, today we're at April 23rd. So if I have till, May 23rd, essentially to do all my hard inquiries, it should only roll into one impact on my credit score, one inquiry impact my score. All right, so student loans are something that comes up in our conversations with clients. And, for those of you that are attending tonight's class that maybe have federal student loan debt, if you're not in repayment right now, it's probably in forbearance, given some of the pending litigation going on with student loans. So from what I've heard, is some of that litigation will be settled in September, October, it looks like. But right now, the way those report to the credit agencies is in forbearance or a zero payment. Now, when it comes to financing, we do have to count a minimum payment when it comes to qualifying on student loans. And so that's why we like to share these in our classes. If you are in an active income-based repayment situation, so let's say you are making payments on your student loans and you have $75,000 in student loan debt, if you're at currently a $250 payment, we can use that payment to qualify you. So, sometimes we'll have clients that are on the SAVE plan, for example, and we can use that $250 payment to qualify them. Now, but if they've entered forbearance because of the pending litigation, then by default, we would have to either use 1% of the balances for an FHA loan. I'm sorry, 0.5% of the balances for an FHA loan. So that would essentially be a $375 payment. Or for a conventional Fannie Mae loan would be 1% of the balances or $750. So we're going to have those conversations as we meet with you for your consultation to figure out, how we need to structure your financing given student loans. But, oftentimes we get questions in our classes about, thinking student loans will hold someone back from purchasing a home, which is not necessarily the case. I mean, we just have to better understand really what the payment is going to be on those student loans, and then how does that factor into the income that we are looking at? Because ultimately in lending, we're going to look at your expenses versus your income. And we're going to learn a little bit more about this tonight, but ultimately we don't want those expenses to exceed more than 45 to 50% of your pre-tax income. So our takeaway here with student loans is that if you're in forbearance or maybe even deferment because you're back in school, we do have to count a minimum payment for qualifying, but certainly we'll help you kind of sort through that in designing your own home buying options. Now, with those home buying options, we look at different loan programs that are available to you. So in this section of tonight's class, we want to spend some time looking at some of the characteristics of these programs. If you're exploring home buying, and of course you probably are, because that's why you're in tonight's class, you're probably learning about some of this stuff online. The two of the more popular programs would be the conventional and FHA programs. But we're going to give you kind of a high level look at each one of the programs. So the conventional product is a Fannie Mae or even like a Freddie Mac loan, which has a minimum down payment for first-time buyers of 3%, minimum credit score of 620. Now, each year, Fannie Mae and Freddie Mac or FHFA set the maximum conforming limits all across the country. So based upon cost of living adjustments, the conforming loan limit is $806,500. So that's the maximum loan amount we can finance with a 3% down payment. Now, you might be joining us in a higher cost of living market. Maybe you're out in California in LA County. You could actually still use a conventional loan up to $1.2 million in loan amount, but the down payment moves from 3% to 5%. All right. The FHA loan program has a minimum down payment of 3.5%, lower credit score requirement of 580. The maximum loan amount will vary based upon what county you're going to be purchasing. So depending on what county you're looking at, there'll be a set maximum loan amount for the FHA loan. We're going to do a mortgage insurance comparison on conventional loans versus FHA loans in just a bit. When we look at these two programs side by side, ultimately, FHA is going to have a lot more flexibility when it comes to qualifying. You can see it just as a credit score. But if I've had some late payments in the past, or maybe I'm new in my credit history, FHA will be a little bit more flexibility in the qualifying as opposed to a conventional loan. But I think one of the things I do see, in building plans for clients, some lenders will make the assumption that just because we're a first-time home buyer, we have to use an FHA loan, because a big misconception out there in the marketplace is that I'm doing a home purchase as a first-time buyer, so I can't do a conventional loan because I don't have 20%. But hopefully you guys are discovering in tonight's class that you can actually put as little as 3% down and still be able to participate in more of a conventional loan product. Now, the jumbo loan product has a 10 to 15% down payment. Not often that a client is going to be a first-time buyer and using jumbo, but it ultimately has higher down payment requirements, slightly higher FICO requirements. And so we're ultimately going to use this type of financing mechanism if someone needs to finance more than a conforming limit, or what we call the high balance loan limits for, say, a conventional Fannie Mae or Freddie Mac loan. The VA home loan is for our veterans that have eligibility. The VA home loan allows a zero down payment option up to a loan amount of $5 million. So if we want to go really high up on that spectrum, it goes up to $5 million. it's ultimately designed to create flexibility for the veterans to have an entry point to homeownership. It also has lower credit score requirements. And if you are a veteran that is receiving any type of disability benefits, there are exemptions for what we call the VA funding fee for a user of the VA home loan. Now, for a VA home loan client that is using that as a first time, usually the funding fee that's charged is 2.15% of the total loan amount. Now, that gets financed into the loan amount, but that's usually the first time fee for a VA home loan. Now, the USDA product stands for the United States Department of Agriculture. That is a rural product that ultimately allows clients to purchase in more rural areas, so in more remote areas, maybe lesser populated areas. It has two qualifiers with it, which includes the location, as I just mentioned, but also has income to household size requirements as well, or limitations. Minimum credit score of 620. Those loan amounts are set based upon the geography or location of the property. So this is really a rural product. Now, the big benefit with USDA, it's a zero down payment option. It can also be complemented with some of the first-time buyer programs that are available all across the market. Okay. So that's kind of a little bit of a high-level look at loan programs. I want to dive a little bit deeper into a topic called mortgage insurance, known as private mortgage insurance for conventional loans, MIP or mortgage insurance premium for FHA loans. Essentially, what mortgage insurance does, it provides essentially protection for the lender in case of default by a buyer. So if I had some economic hardship, I was unable to make my payments, the lender would be essentially protected with that mortgage insurance policy. So on a conventional loan, there's private mortgage insurance, or PMI. So there are private companies that essentially create insurance for that. There's about 7 to 8 of them in the marketplace. PMI is based upon your down payment, what your credit score looks like, and then ultimately how much you finance. So if some of our class has already been diving into Zillow or Redfin and checking out some homes in their neighborhood and trying to get an idea of like payments and stuff like that, I would caution you a little bit because those calculators on those platforms generally don't have the calibration of these 3 factors into them. So if you're looking for more of an accurate payment calculation, I'd encourage you to check out our APM mobile calculator. I'll give you the links to that later on in tonight's discussion. But the PMI ultimately is built upon those kind of 3 key factors for a conventional loan. Now, the PMI does have a cancellation option. So once I reach 20% to 22% equity position in my home, and I have 2 years in that original loan, then I can look to have my mortgage insurance canceled for a conventional product. Now, let's look at an example of what PMI looks like for a conventional loan. So if I'm going to finance, let's say $300,000, and I have a 740 credit score and my down payment's 3%, my conventional mortgage insurance is probably right around $92 a month. Okay. So probably a little bit more reasonable than what you've seen online. Now, the higher I can get my credit score, bigger I can make that down payment, the potentially lower my mortgage insurance premium will go. Now, FHA MIP looks a little bit different because FHA has 2 components to mortgage insurance. One is there's monthly mortgage insurance, which is always set at 0.55% of my total loan amount. But then there's upfront mortgage insurance as well, which is 1.75% of my loan amount. Now, that upfront mortgage insurance premium gets tacked on to my total amount financed. So it doesn't influence my cash out of pocket, but ultimately with an FHA loan, I'm gonna have to borrow a little bit more with the upfront mortgage insurance. Now, with FHA loans, the mortgage insurance is not cancellation, doesn't have a cancellation option like you do see with the conventional loan. So more often than not, we're going to use FHA as an entry point to homeownership, because FHA generally we're going to select that product because maybe we just don't meet the qualifying parameters today on a conventional loan. Maybe it's for credit reasons or down payment, whatever the case may be, but FHA will help support our buyer with a financing mechanism to entry to homeownership. And then over the next 2-3 years, as we improve in our financial standing, then it would be an opportunity for us to refinance away from FHA into more of a conventional home loan product. So this is the calculation of an FHA premium. So you have your same $300,000 loan amount. We have upfront mortgage insurance of $5,250 that gets added into the loan amount. And then, like I said, there's a monthly mortgage insurance premium here. So, the expense structure for an FHA loan, yes, will be higher than a conventional loan, but I think the important takeaway here is not all clients will qualify for conventional, especially for putting that lower down payment of 3%. Question came in, which is what happens regarding lender requirements for homeowners insurance when the insurance company pre-qualifies and says they will insure And after the closing, the inspector comes and determines that the home is not eligible. So that is not uncommon. So, we may close escrow, so get to the final stage, which would essentially be step 6 in our process. You get the keys to your house and then quickly find out that maybe the insurance company is requiring you to replace the roof, or maybe they're not happy with the wiring in the property, whatever the case may be. So at times, depending on how much scrutiny the insurance company is going to place on your property, you may have to make repairs to your property, or maybe select a different insurance carrier. So insurance, depending on where you're at in the country, can be a challenging component. We do see some challenges in some of our Texas markets, and certainly in California with the wildfires that we incur here. So that is certainly a conversation to have. As a home buyer, your insurance will certainly be in place once you take ownership on day one of getting the keys. It's just a question of if there's any follow-up items, insurance carriers can request certain things be done from you. All right. Thanks for that question. I think that's really important. Let's talk a little bit about qualifying income when it comes to purchasing a home. So as I'm thinking about pursuing home ownership, and maybe I'm new on my job, or maybe I've started a new business perhaps, let's just kind of go quickly through what generally as a lender we're going to ask for. So usually as self-employed individuals, we need to see the last 2 years of tax filings. If I'm an employee of a company, then I need the last 2 years of W-2s and like the last 60 days of bank statements, pay stubs. And then on the asset side of the equation, usually we'll have to verify the last 60 days of bank statements. All right, so that's what that usually looks like for general documentation. Now, there's a few scenarios that I think might be helpful for you in this income space to understand. We do have to check back the last 2 years of education and/or employment. So it's okay if I'm new on my job. If I just started my job January 1, but I graduated from A&M in the fall, and now I just started my job, you could still potentially have eligibility for home ownership as long as I can piece together maybe my 4-year history at A&M plus my job, and I can validate that. That would still meet the 2-year requirement. So you don't necessarily have to have 2 years on the job. I just have to show that I have education or employment history spanning over that 2 years period of time. Now, if I have dual employment, so we have some employees, or I should say clients, that are working for 2 employers that maybe have a 20-hour work week schedule at one, 30-hour work week schedule at another. In that case, we do have to show and demonstrate that a client can handle both jobs simultaneously for at least 2 years. So in that case, we would have to demonstrate 2 years on both sources of employment. Again, you heard me speak of self-employed or independent contractors have to have 2 years of tax filings. In that case, we do have to show that we've had a business established for 2 years. If I have an employment situation where I work for a 40-hour work week schedule, but I have a little extra time on the weekends and I drive for Uber or do DoorDash, right? You're paid by DoorDash or Uber as an independent contractor. Now, we can use those other sources of income, but they have to show that you filed 2 years of tax returns on the Uber income simultaneously with being on your 40-hour work week job for 2 years. Okay, so that's where that 2-year requirement gets a little trickier. If I have other sources of income from a partner that's in my household, but maybe they're choosing not to be on the application for whatever reason, I can't introduce that income for my qualifying unless they do want to participate in equally qualifying for the financing. All right. We had another question that came in, which was, what if you get a new job? Does that change anything or no? Not as long as you've had consistent work history for the last 2 years. So yeah, it doesn't change anything as long as we can show that you're actively employed at this point and we can verify a 2-year work history. Now, if you're in an incentive plan where you get bonuses or overtime or commissions, right? We do have to show that you've been on that employment schedule or pay schedule for 2 years simultaneously. Because when we get into variable sources of income like that, that can change based upon how many hours I work or how my performance is on my job, those kind of things. Now, if you're on a straight base salary, and let's say you're making $50,000 today at one employer, and now you got a new job opportunity of $60,000 a year, we can use that $60,000 job right away for qualifying. All right. All right, we're going to continue on with our theme of income, but I'm going to compare that to income versus expenses. Before I get to that section of debt to income ratio, Let me answer a couple more questions that came in. You guys have been awesome with your questions, and I'll keep us on track for our timing, I promise. Is it better to buy a house together as a couple or under one's name? The income is 2 to 3 times difference between the two. It really just depends on if you want to buy solo or with a partner. That would be a conversation, we would encourage you to have with us during a consultation. Because, some first-time buyer programs you may be excluded from if your income hits a certain threshold, or maybe, applying together, maybe the one person's credit score is not as strong, and that could influence your interest rate. So there's a variety of different things we'll have to talk through on that. What I always encourage clients to do is apply together as a joint application, whether you're married or not. And then let's kind of figure out strategically what the best setup is for your financing. And then question was about breaks in employment. So if you've had a break in employment, we just got to have to better understand it. So, we saw a lot of this obviously during the pandemic with layoffs and whatnot. So if I was out of work for a year, for example, as long as I can document the reason why I was out, and then we can show like consistency, we'll just have to probably go back another year to show that full 2-year history. But as long as we can explain it, generally breaks aren't an issue. All right, you guys are doing awesome in questions. Okay, I got one that just came in, but I wanted to get to this next topic and so I can keep us on track. So, and because I do want to kind of address this for the group. I know Ken's typing away here, but I'll also kind of comment on it. So we look at an expense versus income ratio called debt to income ratio. Essentially is today's expenses that I have, which would be like credit card, personal loan, and student loan debt. Then we also factor in the new housing expense, my principal and interest of my loan, property taxes, insurance, possibly mortgage insurance if I'm putting less than 20% down, or if I'm buying a condo, maybe a townhouse, HOA expenses. So we take those expenses and then we compare that versus your pre-tax income. So we put a calculation up on screen here. You have an estimated housing budget of $2,500, other expenses of $500, and someone that is earning $8,500 pre-tax. So that would essentially tell us as a lender that we have 35% of our income being consumed by expenses, right? Now, the guidelines in terms of how we look at lending will allow us to go up to 45 to even 50% expenses to income, which is obviously quite on the high side. For most of our clients, they feel pretty comfortable when that expense ratio is 33 to 36%. I would call that like the comfort zone, if you will. As we inch higher and higher up on that scale to 40, 45, 50, it obviously changes the dynamic a little bit. Some of our higher cost of living areas across the country that we lend in, it's just kind of a product of the market. But ultimately, a good number is 33 to 36% that we see most being affordable for most clients across the country. All right. Now, when we design home buying plans for us or for our clients, there's kind of 2 big goals or takeaways for us in those sessions is one, let's create a plan that's affordable, right? So we can, be able to have a payment that feels good to us. And 2, let's make sure that plan is sustainable for you, right? So if things change economically in my household, it's not going to be a strain to still afford my home. And I want to be able to still, be in a great position financially. Okay. So that's kind of a look at expenses versus income. Now, the last component we want to talk about before we go into the buying process is talk a little bit about down payment. Now, you heard me mention assets or just saving in general is probably one of the top 2 challenges towards home ownership. So I'm going to give you a savings plan tonight as kind of one of your takeaways. But before I do that, let's talk about what acceptable documents we use in the home buying process. So we always have to verify the last 60 days of assets when it comes to your home buying. Usually we do that by verifying like bank records. Sometimes clients will use 401k loans, even brokerage accounts can be used. I always tell clients when you start getting into more of the investment vehicles and accessing those funds, talk to your financial or tax advisor before you dip into those type of assets, because we don't want to create any tax liability or obviously change the performance of one of your investments. And then gift funds can be also used. That's when a family member essentially is supporting you with home buying. Now, most assets have to be seasoned for 60 days. And we're really looking at that on bank records. So we can't just put $20,000 in our bank account and use it. It has to be seasoned or sourced. But gift funds, as long as we know who the donor is, those can be used right away in a home purchase transaction. Now, when we think about savings for home ownership, and especially as I work with new buyers on this path towards home ownership, a lot of us maybe are new in our careers and maybe our income looks really great, but maybe we're just still trying to kind of find our footing financially and we haven't really saved up enough. So what I like to do in our classes is to provide a very simple, but I think really effective savings plan, which goes like this. So if I have, let's say, a $1,500 rent expense today, but based upon my income right now and my trajectory of earnings, I think I can afford $3,000 a month. Right now, I have about a $1,500 gap from where I'm currently paying to what I think I can afford in homeownership. So what I would encourage our client to do is develop a savings plan or start saving like you're making a mortgage payment today. So at the first of the month, when I'm sending in my transfer to my landlord for my rent payment, get in the discipline of now saving that additional $1,500 surplus and transferring it to your savings account as I make that monthly rental payment. Because as you do that over 6 months, now you've accrued $9,000 in savings. By the end of the year, maybe it's $18,000. And we're not including high yield interest accounts that you can still get today at 3% plus in interest. So it's doing that, but it's also creating a rhythm of making a bigger payment. Because as we looked at our buy versus renting calculator, like your payment's probably going to be higher when you decide to take that path towards homeownership. So if we can start getting that rhythm of paying a higher payment now, it doesn't feel as big of a payment shock when we start taking over that new mortgage payment for our home purchase. Okay, so that's our savings plan. Again, I think a really simple way of approaching how to start that savings plan for homeownership. Question on our chat going back to credit, which was my credit report says Capital One checked my credit score. Oh no, my credit report says Capital One checks my credit score every month, though I'm not affiliated to them. I guess it's to send their ads. Yeah. So yes, all your credit card companies do provide tools to check your credit report. If you click on the link, they're probably sharing data. So you just want to be careful on that. I would suggest subscribing to some of the like soliciting platforms. Equifax, TransUnion, and Experian do offer tools. I subscribe to Experian myself just because I like the tools. The mobile app seems pretty easy and the alerts are good. So you may want to check out that. But you are eligible for one free credit report per year. So you can go to freecreditreport.com. But yeah, a lot of those companies like Credit Karma and stuff like that will try to solicit you with your credits. So. All right, let's talk a little bit about first-time homebuyer programs. I know since most of us, I think, are in the state of Texas, maybe some neighboring states, I want to kind of spotlight a really cool program offered through the Texas State Affordable Housing Program. We've got a chance to help some of your fellow alumni with this product in the state of Texas. And what it ultimately does is allows you to get up to 5% of your sales price in assistance that can help ultimately kind of lower your out-of-pocket expense for homeownership. Some of the programs can include grants, deferred forgivable loans. Usually when you're in the home for at least 3 years, the assistance you get from the Texas State Affordable Program is deferred. There's also special incentive through our what we call the Texas Heroes Program, which would be military, first responders, and teachers and others, which can discount the financing, which is a really awesome opportunity for our first-time buyers. And one of the things that I love about this program, it provides a mortgage credit certificate, also known as an MCC, which essentially today will provide up to 15% in a tax credit based upon the interest that you paid on your mortgage. So let's make the math really simple for tonight. So let's say I paid $10,000 in interest on my mortgage in 2025 this year. If I had an MCC, I would get a $1,500 tax credit on that interest that I paid that would ultimately help lower my tax liability for my federal return. So really great opportunity. We've got a chance to do a few of these in the last few months. Now they've recently changed the MCC from a 20% tax credit to 15%, but it's still a super awesome opportunity for first-time buyer programs. If you'd like to learn a little bit more about that, we can certainly talk more offline, but that is this Texas State Affordable Program. It's available for FHA, USDA, VA, and for conventional home loan buyers. There's also some national programs that are available too through Freddie Mac. There's the Borrow Smart program, allows grants up to $500 to $1,000 that can ultimately reduce your out-of-pocket expense. We also have a Pathway DPA program, which stands for the Down Payment Assistance Program. It's only for FHA, but allows anywhere between 3.5% to 5% of the loan amount in assistance. Now, if you're in another state other than Texas, and I know there is specific first-time buyer programs by state, We don't have enough time to go through, obviously, every state based upon our attendees for tonight's class, but I would encourage you to get connected with me after tonight's session. We'd love to be able to walk through what some of these programs can do for you, because they're ultimately designed to support low to moderate income household buyers all across the country. All right. We're getting close to the end of tonight's session. Thanks for everybody for hanging in there. I do want to spend some time really quickly looking at the home buying process, because as you leave tonight's class, you may say, hey, I really want to get on that journey towards home ownership. I really want to make this a goal for myself this year or next year. So I want you to know kind of what you're going to experience as a buyer. So this is our 6 steps of home buying. Really simple look at the milestones of home buying. Step 1 is the pre-approval, which essentially is the output of a consultation. I meet with all of our clients through our partnerships across the country to design home buying options for them. We get a kind of a strategic plan together, and then a pre-approval is the output of that session, which ultimately allows a buyer to go out and confidently make offers on homes, knowing that their lending is all qualified. Now, that pre-approval is good for 60 days, but it can always be recertified at any time. So when a client applies with us for financing, their application stays live for 2 years in our system, so they have plenty of time to go out and shop. But the pre-approval lives for at least 60 days, but we can always recertify that at any time. Now, as we get pre-approved for our home purchase, then we go to the house hunting phase. Usually that starts online, and then we'll probably transition to going out and physically looking at a property. We encourage clients to get connected with a local realtor. We have preferred realtors across the networks that we serve, or the communities that we serve in our network. So we can always get you connected with someone that's a professional that really understands their market, some of the, the aspects or characteristics of a community, and really probably is an expert in negotiations. But that would be a partner of yours that would help you in the house hunting phase. Now, as you identify a few properties that you like, you may say, hey, you know what? That's the property I want to try to go after and make an offer on a property. Now, if you make an offer and let's say that offer gets accepted, then you move to step 3, which is essentially the entering escrow phase of the process. It has different terminology depending on where you're in the country, but ultimately it says, a seller has accepted your offer. And usually from the time of acceptance to the time you get the keys, which is the fun day, right? That takes about 30 days in most parts of the country. Now, within a 24-hour span of time, once your offer has been accepted, you're going to get a call from me saying, congratulations. Hey, you did it. Your offer's been accepted. And now we're going to walk you through the next steps in the process, which includes doing a follow-up consultation together to make sure that we're on the same page when it comes to the design of your financing, what you plan on putting down, what the interest rate climate looks like, total out-of-pocket expense, all that fun stuff. Now, one of your out-of-pocket expenses is what we call an earnest money deposit, which ultimately is kind of a good faith deposit that tells the seller that you have a financial stake in the success of this transaction. Most parts of the country, that earnest money deposit is 1% to 2% of your sales price, and then gets counted towards your total out-of-pocket expense. Now, in some contracts, there's what we call a contingency period that exists, what ultimately allows you as a buyer to do your due diligence or homework on the property. And that due diligence period is anywhere between 10 to 21 days, depending on the length of the contract. That includes getting an appraisal done to ensure the house is worth what you're buying it for, getting inspections done on your house, which your realtor will orchestrate that, and then getting your loan approved. So why I share that with you is because your earnest money deposit is safe while you do those checkouts, if you will. And so, as you get more comfortable with the state of that property, we'll get to a point where you can sign off on the contingencies of the contract. Now, behind the scenes, we're doing some of the administrative work of the financing, which includes the processing of the loan, underwriting of the loan, which essentially is reviewing all your income, assets, credit, make sure the product type is correct. And then we'll issue that loan approval to you. Now, our team will kind of partner with you to make sure that we have everything correctly fit for you. But at step 5, we're almost towards the finish line, believe it or not. And so when underwriter has completed your review, we have all the conditions for your financing. Your contingencies are probably removed at that point. And at that step 5, we're going to issue to you a final closing disclosure, which essentially gives you a 3-day cooling off period before you get to the final stages in the process. Now, in our process, it's all done via video and online, and we're going to be sending out disclosure notices to you as you move through the process. There's the initial disclosures that you get within 72 hours of your contract period. Once we lock in your interest rate, you get another set of disclosures, and then you get a final closing disclosure at step 5. Well, the final stage is step 6, which is the end of the road, which is a good end of the road because that's the date you actually close on your home loan. In Texas is what we call as a table funding state. So when the date you sign your final loan documents, we also fund the loan. So you're going to sign your loan documents, which takes about an hour. You also make your final wire deposit. And then at the same time, once we have confirmation you've signed with the title or escrow team, then we wire in the funds for the transaction. Those monies get then reconciled to make sure everything's all kind of checked off, and documents get recorded with the county recorder's office. So they'll record generally a transfer of ownership document called a grant deed in most parts of the country, and a deed for the loan, which is ultimately your repayment instrument for the loan. And once we get a confirmation that that's all been done, guess what? We get a chance to call you and say, congratulations, you did it. You're now a homeowner. And it's my favorite call of the day because, hey, it's a huge celebration. You know, it'll start from a class like this, like we've had with our fellow A&M alum. And then next thing you know, we build a home buying plan, we get pre-approved, we find the house, and then guess what? We get the keys to our house. So it's a really cool day that we get a chance to experience with you. Our relationship doesn't stop there, though. We have an aftercare program that we're really proud of that monitors rate activity. So, you know, when it makes sense for you to refinance, we're going to start making sure we stay connected on that. We're always kind of tracking equity through our HomeBot system that we'll be pushing out notifications there. And we always do annual check-ins with our clients. So, you know, it's not a transaction for us in our partnership. It's more of a relationship that changes over time because obviously we buy our first house, then we outgrow that one, we go to the second or the third home, or maybe we're buying an investment property. So we want to be here on every one of those financial milestones for you. Now, if you're thinking about moving forward after tonight's class, and we really hope you are because we'd love to partner with you, there's a couple ways you can get connected with us. You can connect with us for an introductory call just to ask some questions about maybe products or maybe a scenario for yourself, or to schedule a free, no obligation consultation. We'd encourage you to follow this easy 3-step process. Includes online application, you do an upload of documents, and then you use our scheduling system to schedule your video consultation. And that's a 30-minute session that I do with every attendee from our class that elects that option, just to help provide that customized home buying plan for you. And this is kind of what that looks like. We're really proud of what we do for our clients. We consider ourselves different in the fact that, you know, we really understand what a big investment is for you. So we want to take the time out to do things the right way and provide a really comprehensive plan for you. Last thing I want to touch on before we wrap up, I know we're a couple minutes over, but I got some good questions in there that I want to hit on too, is some resources that are available for you on mobile. So you can start your application right there. You can follow the progress of your loan, even do calculations, which I mentioned earlier to you, that you can kind of do calculations. Maybe you're at an open house and you want to see what this house payment looks like. Just want to reiterate our benefit of our closing cost discount with our Association of Former Students of Texas A&M. You get a $750 discount on your financing. The classes obviously are free to the public, so we'd encourage you, if you want to check out the recorded version, or maybe come to another live class, you're always welcome to do this. We'll do 4 of these every year for our Association of Former Students. So this resource is always available to you. And again, a consultation is a no obligation, and it's a free soft credit check, so you don't have to worry about that. We do have other partnerships across the country. So if you have friends, family, maybe some coworkers that think would benefit from our educational platform, they can check all of our upcoming classes we have available on our website. And here's all my contact information. So if you have any questions, feel free to reach out to me. Love to be able to get connected with you. And of course, we have our social channels. You'll see the YouTube video of tonight's class up tomorrow on our YouTube channel at J Meda Mortgage. All right. I got it in. I got some questions there, and I know a lot of you are holding out in our Zoom session, so thank you for that. Let me see if I can answer a few of these questions, and if you guys want to hang in there with me. Let's see. We talked a little bit about homeowners insurance. I saw the question about the discount, so we just hit on that. We do have the $750 discount, so that is available to you. And question was, is there any substantial differences in financing a property through an LLC compared to maybe an individual? There is substantial differences. So for most institutional lending options, like what we're going to offer, it has to be lending to an individual, not an LLC. There are companies that lend to LLCs, but there will be a change in kind of the dynamic of the financing. Okay. I thought I had another one in there. Okay, I think we got them all. And thank you for the positive comments in the chat there. We appreciate that. I think we got everything. Okay. Into the system. Okay. And yeah, so I think your question about if you're eligible for the discount, if you're in the A&M system, absolutely, yeah, you're eligible for the discount. So you don't have to necessarily be in College Station. So we will definitely make sure you're well taken care of on that. All right. Cool, cool, cool. All right, everyone. Well, I know we're in different time zones across the country, whether you're dinner time or wrapping up your day. We appreciate the time with us tonight, and we really look forward to getting connected with you soon to build your own home buying plan and help you on that journey towards home ownership. Have a great night.